All right, looks like we are at time, so let's go ahead and get started. Welcome everyone to Around the Valuation World. My name is Chin Chun and I'm with NACB and the Consultants Training Institute. Before we get started, I want to go over a few housekeeping items. To attain CPE credit for today's webcast, please answer all the poll questions that pop up on your screen. CPE certificates will be available on the nacba.com portal in 7 to 10 business days after today's webcast. If you have any questions during today's program, please use the Q&A option for your presenters. If you have any technical questions or questions about NACBA, please feel free to use the chat feature, as those will be directed to me. And with that, I'm going to turn the time over to Mel and Alina, who will get us started for today.
Thank you, Shanda. Hello, everyone. Welcome to Around the Valuation World. We are on our March 2023 edition, and today we'll have several segments that are going to be very interesting. We have Michael Gregory as every month. We also have Ed Mofrad interviewing David Goodman, talking about industry intelligence. And we have Roberto Castro and Simon Rubinsohn talking about economic updates and information that is really relevant for us. And then for everyone, just make sure that you have your questions on a paper, because today we have an open forum Q&A with the judges, and that's going to be it's going to be Michael Kaplan doing those questions to the judges for you. And we also have in Michael Mulder talking about federal and state case law. And Brien Jones is going to be interviewing Will Casserly. So now I'm going to leave you with Michael Gregory. He's one of our correspondents. He's with us every month, and he's a mediation and negotiation specialist. And he has a lot of knowledge that he's going to be sharing with us today. Mike? Are you there, Mike Gregory?
I am here.
See if you are around.
I am
Okay.
here. And I'm going to try this again. Sorry about that.
It's okay.
And here we
You
go.
can take it from here.
Okay. You have one slide on the screen?
Yes, this is a correct view. Yep.
Yes.
Very good. Well, thank you. Happy to be with you here today. Take you through a few slides. And this is who I am. It's my pleasure to be here. I'm on here monthly with about a 10-minute segment. And this is what I do. I focus on mediation and negotiation relative to IRS and other disputes. And today we'll be talking about a number of topics. I'll be talking to you about vertical IQ. There's some changes with respect to that, if that's something you currently have, or that's something you're thinking about. I'll talk about BizComps. Now has over 15,000 transactions, and I'll share that with you. There's a new deal alert feature in Deal Stats, if you use that. And then NACVA has 2 super conferences coming up. So if you don't have those on your schedule, you might want to put those together, and you can attend in person, virtual, or you can be on board for just some segments if you'd like. Then I have a commentary on dental practices take the top spot in industry research on vertical IQ, and some comments around that. And I talked to some people, 2 different firms that just specialize in all they value are dental practices. I'll share some information from them. So for key objectives and main takeaways from today, we're going to talk about vertical IQ, BizComps, Deal Stats, and I couldn't do that without a reminder on what NACVA also offers. So select dates for one of the 2 super conferences, apply lessons learned from the moderate. And I've done some additional research on that. I'm going to share some information even from this morning when I reached out on Dr. DeModerin's website and did some research on him relative to inflation and other comments. You may want to check that out for yourself too. And then reference what's happening in the dental industry, if that's an area that you focus on. And there are some other industries that also are some of the top industries that are researched. So vertical IQ, they have enhanced their program. They have 11 industries, and those are included there. You can see accommodation, food service, agriculture, forestry, fishing, educational services, information sector, real estate, transportation, and warehousing. And they offer a big picture, a macro look at the major segments of the U.S. economy. And we're going to get some features relative to the U.S. economy here in just a few minutes. And then a narrow review with respect to 570 distinct industries. So they advertise in their brochure, they cover 97% of the U.S. economy, and they have sample reports, and this particular service costs $1,200 a year. And then BizComps, it has over 15,000 transactions, actually 15,165, 500 industries, 21 data fields. And you can search not only by an SIC code, you can put in key descriptors of whatever it is you're looking for, and it'll help research those as well. There's an infographic that's available, and you can buy this at $629 a year or a single search at $229. And you'll see later, it's incorporated in one of the packages here from NACVA as well. New deal stats or new deal alerts from deal stats. If you belong to deal stats and you're doing some research and you want to know what the most current information is as you're writing your report, they have a new alert, and it'll notify you when something new happens. And you have yourself notified in terms of how you want to get that. Do you want to text? Do you want to email? How often you want it? Do you want it once a week, once a month, once a day? Or do you want to have it when it comes in on just a particular topic? And it could be too, just when you log in, it'll tell you about new things. So you determine the frequency and what you want to know. There's a tutorial available with this, and this costs $1,125 a year. And then I'd be remiss if I did not bring up what we have from NACVA. NACVA has Econ Assist, and what that includes is listed there in that fourth bullet. This is free to all members with Econ Assist. But NACVA also has a partnership with Value Source, with David Fine with the Value Source. And so in key value data, there's a bundle you can get. They have 4 different ways you can purchase this. It's $995. And it has the biggest selection of valuation databases, which includes BizComps. There are 5 different subscription levels, so you can decide what you might want to do with that. But I wanted to give you the update on what the most common sources are that people are using. There are 2 dates set up for this new super conference. One is in Snowbird, Salt Lake City, July 12th to the 14th. I've been there before. That's fun. I think you might enjoy that. If you want to get away from the cold, I know we're thinking about spring now, but as we get through summer and fall and you start thinking about colder weather, Fort Lauderdale in December doesn't sound so bad. So those are 2 different options you have for you. And as I said, you can have an a la carte option for individual sessions. There's also currently an early bird discount if you want to sign into that. And then in terms of DeModern, I did some research today. If you research on DeModern, again, he's a professor at NYU, New York University, Stern School of Management, and you put in inflation, he has some commentary with respect to this. Here are some points that he has in a recent article. The trends on valuation impacts and inflation and profitability. It says, depends whether you're in a high margin area or a low margin area. So the impact of inflation will make a difference on your profitability depending on what your margins might look like, as indicated here. He says the U.S. cost of capital increases from 5.6% to 9.63% from the beginning of 2022, January 1 through December 31st of 2022. And then he points out that 70% of all listed firms earn returns lower than their cost of capital. I'll repeat that again. 70% of all listed firms earn returns lower than their cost of capital. So they're not even meeting their cost of capital for about 70% of the firms. He commented, what firms really need to do is focus on making money rather than growth. So there's this whole splurge on, should you get out there and work on mergers and acquisitions and grow our company in terms of revenue that way? And his comment back is, you really need to focus on making money. On the information I heard on CNBC that I looked at this morning, he commented that inflation is something he has seen in his lifetime, and I have too. And he says, it's very hard to put the genie back in the bottle once it's been let out. It takes a long time. So the idea that we'd bring down inflation in 6 months or a year or even 2 years or how long it's going to take a long time. It's very hard to bring inflation back down. So very long term, it's quite possible we could get back to something like 2% inflation with the goal from the Fed. But it's going to take a long time to get there unless there's some kind of major shock. So he said if something negative happens in the economy, some kind of major shock, that could knock down inflation. But otherwise, it's probably going to be around for a while. It's going to take a while to get that down. And then in terms of dental practices, at Vertical IQ, they looked at which topics, which industries were looked at the most. And number 1 was the dental industry. And from this article that I have indicated here from the source up front, says it's the most popular industry profile. They don't know why, and they're guessing, are there more dentists retiring? Are there more divorces? I'll get to that in a moment. And then it says, these are also very high searched items: full service restaurants, HVAC, plumbing contractors, physicians' practices, law firms, truck companies, lessors, residential building, and others. Well, having read this article and have identified this for our group for today, I went and said, I'm going to reach out to two firms that all they do are dental practices. And they said, Mike, what's happening is conglomerates realize that dental practices are very profitable. So conglomerates are coming in and buying dental practices. So I spoke to one dentist that he says he's on the board of a dental practice that has 1,100 dentists in it. And he says, we get 2 to 3 solicitations a week from different folks that say, we would love to bring your market segment into our conglomerate. What does your group of 1,100 dentists want as a price for us to buy this? And the dentists are coming back and saying, well, actually, we're doing really well. We've got 1,100 of us in here. We're all shareholders in this conglomerate ourselves, and we don't want to sell to somebody else. But he says there's so much consolidation in the industry that conglomerates are coming in and saying these dental practices are profitable. We want to take a share of that for our own investment. So that's the theory I have from 2 of the dental practices, and that's what I found out from a board member of a group of 1,100 dentists. And then each month, here are my sources. So this month it's Vertical IQ Industry Reports. You can go there. Here's BizComps if you want to look that up. Here's the Deal Stats tutorial. Then the next one is the link to our NACFA conferences that are coming up in Fort Lauderdale and in Utah. And then here's a 5th update by Demoterin for 2023. If you want to get more on inflation specifically, I found just by Googling on that name and NYU and inflation outlook, you can get his latest updates. He comments, if inflation goes down in a given month, everybody gets excited. If it goes up in a given month, everybody gets excited. But the reality is, this is a long-term item. It's going to take a while to bring that down. And these are the sources I use each month: BV Wire, BV Update, the Value Examiner, NACFA CTI training summaries, valuation products and services, IRS information, and a few other sources. And if you need to get in contact with me, here is my contact information. Here's my contact information, phone number, and email, and feel free to reach out to me on anything that I can help you with. I get 2 or 3 calls every week from every week from different sources, and if I can help you, I'd be happy to do so. Thank you very much, and I'll pass it back to either Mel or Elena.
Thanks, Mike. It's always great hearing from you. And our first poll question is up, so make sure that you get these answered so you can get the proper continuing ed credit as we go to our next segment. And our next segment is I'm going to introduce Ed Mofrad. Ed Mofrad is going to introduce the guest. It's an interesting topic and something that we're all challenged with, and this is how do we figure out specific company risk. And so Ed has been in the industry for a while. I had no idea, Ed, that you were a prior IRS agent, so we won't hold that against you. He's the president of Mofrad Financial Solutions, does business valuations a lot in the IT healthcare space, as well as wealth management, and has been around the world a bit, doing stuff. So Ed, welcome aboard, and I'll let you introduce your guest.
Thank you so much. Just to be introduced by the great Mel Abrams is a honor in itself. I'm truly honored. Thank you. Just a side note, I'm wearing this because I actually did run the LA Marathon yesterday. It was my 18th marathon in my old age, and I'm sitting here, but I am in tatters right now. Other than that, let me introduce my esteemed, honored guest. I'm very proud to be introducing him and interviewing him. His name is Mr. David Goodman. Like myself, he's an MBA, CPA, and a CVA. And he's an expert in what he is going to be talking about, which is a hybrid approach to determining the company's specific risk premium with Monte Carlo simulation. David is joining us today from Massachusetts from his firm, Jessen, Olson & Associates, LLP. David, it is my pleasure. Give us an overview, a hybrid approach to determining risk. Please tell us, give us first an overall view of what you mean to express by that.
Yeah, first I'm going to correct one thing. I'm actually in Norfolk, Virginia now. I
Oh,
work remotely for my firm and with a firm in Massachusetts.
you get
we
around,
moved
my
about-
friend. Sorry
We
about that.
moved
I didn't know.
about 2 years ago. I've published, or 2 articles were published in the Value Examiner, one in was it August, September, and then another November, December. In the first article, I proposed a hybrid model using something called the risk rate component model and the multi-attribute utility model to derive company-specific risks. And then in the second article, I added Monte Carlo simulation to the model. This all started quite a number of years ago when I think it was the Delaware Chancery Court came out with a case in which the judge said, gee, the company-specific risk is just something that business valuators use to get the end result they want. And that has always bothered me. And then I had an engagement where we started getting engagements to allocate personal and enterprise goodwill. And after studying that and reading B.B. Resources' book on it, we used David Wood's MUM model to allocate personal and enterprise goodwill. And it occurred to me that that model would be really good for coming up with a company-specific risk premium. So that prompted me to start working on that. And the model I developed it's for small businesses. I don't value really big businesses, but most of us just value small businesses like under $3 million, if not much smaller. And it's also not for exceptional risk situations like, say, a cannabis industry or a company that has a particular risk factor that might need a much higher risk rate.
I see. Now, under what circumstances, let's say if a small company came to you and wanted you to do this kind of valuation for them, what circumstances do they need to be in to make this particular model ideal for them?
I think in most cases, I've been playing with the model on engagements we use, and in most cases, it works fine. The range is between 1% and 9%. So if you think your company-specific risk premium is likely to fall within that range, the model works great. If you're going to get outside of that range, then what that means is a particular attribute is weighing very heavily and the model is not really built for that.
Can you give us a demonstration, an overall brief demonstration of how this model works?
Okay, well, let's talk about the MUM first. If you think about it, we all actually use this model every time we decide to buy something, whether it be a car or even a business or a diamond ring, or maybe even whether to go to a conference or not, which is we decide what things about that are most important to us and to what extent does that thing have those things. So when we apply this to company-specific risk, we have multiple attributes, and with those attributes, we have the importance of them to us. And then we have what's called an existence utility or existent, and it's to what extent does that attribute exist, or in this case, to what extent does it increase risk? So for example, let's just take a look at supply stability. We hear a lot about supply chain interruption today. And let's take a company and say the supply chain stability is very important to them. So we give it a high risk or a high importance factor, I mean. And then they say, okay, we've been able to get by. It's been, uncertain, but we think it's going to continue the same way in the future. So maybe we say that has a moderate risk. Or maybe the management tells us, boy, we're got word that it's going to be totally disrupted or prices are going to shoot sky high. We don't know what we're going to do. We would give it a very high risk factor. Or they may say, yeah, we were having issues, but now everything's running like it used to, in which case we would give it a low risk. So with this model, I identify multiple attributes in different groups, which I'll talk about in a moment. But you take the importance utility times the EU, and you come up with a multiplicative utility, and you add these up for each attribute. group to come up with the total multiplicative utility. And then you come up with a grand total of all those. And that score is then references a table where I have ranges of what the potential company specific risks might be. So a score of 150 might result in a risk of 3%. A score of 450 might result in a risk of 8%. And all in the model, I have 36 attributes, I think divided into 7 different categories. The nice thing about this model is you can modify it the way you want. The only thing you have to do is keep 36 attributes, but you could actually change those if you wanted to. If you had more attributes, then you would have to play with the model, and I don't have time to explain how to do that today.
David, is there a software that you recommend using for somebody who's applying this model?
Yeah, if you reference the articles and you email me, I'm providing everyone for free the spreadsheets I developed in conjunction with the articles.
I see. This cannot be all positive. Like everything else, it must have its criticism. So I must ask you, what have been some of the concerns that are expressed about this model?
The advantages I find with the model is it not only shows your qualitative analysis that you use in analyzing company-specific risks, but allows you to quantify it. And I think it makes it more defensible. And also, in the articles, they show how the model is consistent with the 3 basic principles of economic value. And it provides a methodology to make sure you address all the key issues impacting the company's specific risk. And if you take it a step further, where I've added Monte Carlo simulation, then based on the parameters that I discuss in the article, you can state with certainty that your company specific risk falls within, is 95% certain that it falls within a certain range. And the Monte Carlo simulation basically eliminates the nitpicking that people fear with a model like this, with an attorney going through and saying, well, what if this number was one higher? And what if this number was one lower? And what would that do to your result? Basically, with the Monte Carlo simulation, you are varying all the numbers with a random factor and coming up with an average that then gives you your company specific risk.
I see. Could you elaborate a little more on the Monte Carlo simulation, and how it gets mixed into this and why you even thought about it?
I use something called the triangular distribution with the Monte Carlo. Well, Monte Carlo simulation was actually developed in the Manhattan Project, the project where we developed the atomic bomb, by mathematicians and scientists. And that, yes, they did name it after the casino Monte Carlo. And it works very well in financial applications where you want to vary something that may be an uncertain number. And by taking the average, you can then determine what your standard deviation is and what your standard error is. And you can determine what the probability of it falling within a certain range is. The way the triangular distribution works is you go through and you have a most likely outcome, a worst case outcome, and a best case outcome. So for example, previously when I talked about the supply chain, I went through 3 scenarios, and you could go through that for, say, the supply chain. Maybe there's a management uncertainty, and you could say, well, maybe the son's going to come into the business and everything will be okay, but maybe the son's not coming into the business. Maybe the labor force is going to unionize, maybe it won't unionize. So you can go through and pick certain attributes that are very important to the probability that your company is going to realize that cash flow you're using. And once you have those 3, when you're done with your analysis, you will have 3 grand total multiplicative utilities that you plug into a formula, or you can download software. I have that in my model. And that will generate an average that gives you a range of company-specific risk. For example, it might be 8 to 9% or 5 to 7%. So you're then able to say, my 6% company-specific risk factor, based on this intense analysis I did with 3 different scenarios, there's 95% certainty that it falls within that range. And not only that, but by doing that, I've addressed all the possibilities that I think exist for something being higher or lower. And the Monte Carlo simulation also does that.
I'm fascinated by what you have produced, and I was studying on it over the weekend, and I'm fascinated. And the more questions I ask, the more I want to ask you. Can you elaborate a little more on the, about the 36 attributes that are grouped into 7 categories?
Yes. For example, I looked at financial attributes and determined that in most cases, things like maybe the current ratio, liquidity, debt, Z-score. So I might have 4 or 5 attributes there that I'm specifically looking at. Then when we get into management, we get into the age of management. Is there any transition team in place? Is there anyone who might be able to take over the business if something happens to the key players? In the competition, what's the competition in the industry? What's the ease of entry? Are there industry trends that are going on? Do we have supply chain issues? And so I have these different categories of areas that we might be looking at. And I have sort of a catch-all called other industry risks that I can change. So for example, one company may be heavily regulated, and that may be its own set of risks. Another company may have particular environmental risks that they have to deal with. So you could substitute that in there.
I see. Let's say if this becomes the next big thing and it really becomes a hit, how would you predict it would impact the industry?
I don't know. This is brand new. I think I'm getting interest from people who have looked at the model, and I think it's a useful model to start using. I have not yet put this into our reports, but I'm using it to support the number that I'm putting in the report. I have to admit, to some extent, in the size companies we value, that often the difference between a 3% and a 4% company-specific risk, or a 5% and a 6%, or a 6% and a 7%, it's just not that big. If you look at the build-up formula, the company-specific risk represents maybe 25% of your total risk. But at the same time, I think that when you do get differences, like someone has a 1% risk and you have a 7% risk, this gives you a way to support your number that's going to be much stronger than how they supported their number.
David, as we're talking, I'm already getting requests that people are asking for your contact information. They're interested in it. And as I imagine, people are stimulated just like I was when I read about it first. Can you elaborate a little more about the similarities to David Wood's MUM or MOM for allocating goodwill?
I'm sorry, I didn't quite understand your question.
Could you elaborate? Can you hear me now?
Yes.
Okay. Could you elaborate a little more about David's similarities to David Wood's MUM for allocating goodwill?
Oh, sure. So David Wood, in allocating personal goodwill, established the importance of the attribute and then to the extent to which the attribute exists. For example, the owner's relationships with clients may be very important, and he may be the only person who maintains those ownerships with a client. So you would rate that very high. And then he uses a range of potential outcomes. And the way that looks is if your score is between, say, 150 and 200, this is your result. If it's between 200 and 250, this is your result. And the way it works is you look at your individual attribute, for example, customer concentration or relationship, and the more concentrated it is, it might be the higher the risk. And with that model, he then comes up with a score where he has attributes related to personal goodwill, attributes related to enterprise goodwill. So if your personal goodwill were 50 and your enterprise goodwill had a total score of 50, your personal goodwill would be 50% of 100, and that would be the amount of the goodwill that's allocated to personal goodwill. In the model that I've done here, I don't do it that way. I just come up with one total score that then goes back and references a table that I put together. And I should mention, I didn't put the chart in here, but based on the table that I did, the most often result, if I make every number absolutely random, the most often result that comes out is 5% company-specific risk. The range for which the majority of results come out was between 5 and 7%, but the range was 1% to 9%.
I see. Could you, I know we're challenged for time, but could you give us a rundown of a very simple example of how this would work? A very basic, simple example. If you see it fit to do it in this time frame that we have, David.
Can you see this screen now?
Yes.
Okay. So this is the original model. My model, this does not have the Monte Carlo simulation, which is a different model. But here you can see the table with the ranges. And here you can see in this one, the selected outcome was 3%. My weightings range from less important to moderately important to most important. And then the extent to which a particular attribute increases risk is 0 for no risk up to 4 for very high risk. So here I established the importance for my particular subject company. These are the EUs. This is my extension. This is the subtotal for the financial attributes. This is industry attributes, management quality and reliability, staffing, market risks. And these were the attributes I picked for market risk, regulatory risks, and then other company risks. So this was the basic model I developed. And then depending on what this score is, it references this table up here and returns a risk.
As I mentioned before, we are getting a lot of interest. People are asking questions. One of the questions that I found interesting, let me ask you now, and let me know if it's too much to ask in this time frame. Mari is asking, can this model be adapted to the 9 Mandelbaum factors in the DLOM? Is that something you see fit answering in the limited time that we have, David?
I'm sorry, can you ask the question one more time for me, please?
Sure. Can this model be adapted to the 9 Mandelbaum factors in the DLOM?
I think so, yes. One of the things I'm concerned about with the 9 Mandelbaum factors in the DLOM is there is some overlap between those factors and things we might consider in company-specific risk. So if you're going to be, you just need to be careful not to duplicate those factors. But I think the model could be adapted to that. you'd have to play with it to, the first thing you'd have to do is establish sort of what you think a reasonable range of DLOM is. And then you would have to establish your attributes. And then what I did was I use the Excel random facility and just played with the model until I got a distribution that made sense to me. I could talk to the person about that more. You'll notice in my attributes, a lot of those might be picked up in a DLOM using the Mandelbaum factor. So I think you do need to be careful not to double count. I look at the DLOM personally as more a liquidity discount and focus on things that might impact liquidity or things that might be uncertain to a buyer and cause them to value the company different.
I see. So discount for lack of marketability, or DLOM as you call it, it can easily be tied into your model. That's very good to know. Do you recommend any further reading, or if somebody was interested in studying more on this, some resources we could go to?
Well, I have two articles in the Value Examiner. The July-August 2022 is where I introduced the basic model I just showed. Then in November-December 2022, I introduced Monte Carlo simulation. There is a webinar that's been recorded on BV Resources, and CTI and NACDA are going to be offering a webinar. I'm going to be doing it on March 30th at 3 p.m., which will be a 2-hour webinar where I go into this in detail.
Okay, I was going to say that, but David preceded me. He will be having a seminar on March 30th at 1 p.m. Eastern time, is the best of my knowledge. He's going to be elaborating more on this topic, and he won't have me to cut him off and ask him questions. He's just going to go on his own flow and talk about this. I'll be there. I'll be listening intently. Anything else you want to say about this, David, before our time is up in like the next 2 minutes?
Well, this is me getting on my soapbox a little bit, but one of the things in the articles that I am trying to reintroduce to the business valuation community is Ray Miles, who first proponent of using market transaction data, laid out 3 principles of business valuation that are the basis of every valuation we do for a business, irrespective of the approach or the methodology. And I put the company-specific risk premium in the context of these 3 principles. And for a small business, I think we need to be talking about these more, because I hear some people in the business valuation community who think the company-specific risk premium shouldn't be used. I think they're wrong. And in my first article, I explain why.
I know you you yourself don't recommend your model for exceptional risk situations. Can you tell us why you don't feel it's suited for, exceptional risk situations?
I'll give you 2 examples. One is the cannabis industry. There's so much uncertainty as to what's going on. For example, if you have someone, for example, in Massachusetts, you have an indoor grower of cannabis, and should Congress ever change the laws concerning that, and suddenly it can be shipped across state lines, then the outdoor growers in California would close down all the internal growers. So there's a risk there that single one risk factor is so high. Another example was a restaurant that we once did that had a location in a very good area on Newbury Street in Boston, and they had no lease and were going to be forced to move from that location, and they didn't have another location in a similar prime place. And so we had to give that restaurant a very high, we were like at 40% because there was so much uncertainty as to whether that restaurant was going to survive or be anywhere near what it was. in a new location.
I see. Could you elaborate a little more on quantitative analysis versus qualitative analysis of your model?
Yeah, one of the criticisms that came back to me was someone said, well, I learned way back when my IBA class that a company could have a specific attribute that was more favorable than a company publicly traded. And that might be true for a middle market company, but for me, Joe's Pizza on Main Street, the best they can do is to not be riskier for that one particular attribute. But if you want to have a negative attribute, like a -1, you could add that to the model, and it'll still calculate the company's specific risks. It still works.
Okay, I know that I was told that we have until 10:35, possibly till 10:40. It is 10:40 my time, California time. Should I keep going? I mean, I can go on forever asking questions, or should I stop?
I've got a couple questions. One is someone is asking, which software do I use for Monte Carlo simulation? In the article, I explain how to build it, but I used to do the triangular distribution. You can download a program called MTRAN. I haven't found a good free Monte Carlo simulation program that does what I wanted to do, but it's pretty easy to build it in the spreadsheet. And contrary to popular belief, in most cases, you don't have to use more than 500 rows. And I show in the article on Monte Carlo simulation how the result averages out after about 250. So 500 in most cases is plenty. So it's not hard to build the spreadsheet. Right now, the spreadsheet's not online anywhere that I know, but if you email me, dgoodman@joacpa.com, I'm sending that to anyone who asks for it.
Okay,
spreadsheets.
I'm sorry, David. I'm getting angry messages from the control center that I should wrap it up. So I better just wanted to make one correction. We tend to use acronyms and abbreviations. We used MUM before. I just wanted to specify for anybody who may be confused. It stands for Multi-Utility Attribute Model. And we used DLOM or DLOM before. That stands for Discount and Lack of Marketability. I apologize if you use any other jargons that are for professionals. But if you don't know anything we said, please ask me or David. David, it truly is an honor to be amongst this great group of professionals and to be interviewing an outstanding person like yourself. And we're done. Thank you.
Thank you to Ed and David for your time today and for all the information they have provided to us. And now we are going to go before our next segment. We are going to go to a segment switch where we are going to see information about Start Small, Think Big, our pro bono service project. So we'll be back in a minute.
Roberto.
Hi, Simon.
Hi. Are you able to share your screen?
Okay, I know you couldn't hear it, but let's see if Brien can solve that for later. So to not take more time from Simon and Roberto, We're going to go to the segment now. We're going to have Roberto Castro. He's one of our correspondents, and he's going to be interviewing Mr. Simon Rubinsohn. He's the chief economist at the Royal Institution, RICS. So, and before that, make sure you respond to your polling question. Roberto.
Good morning. Thank you, Alina.
Buenos días. Good morning.
Good morning. I am pleased to have, and by the way, Alina, if you get a chance, I don't see the share screen for or having control of the PowerPoint. So if you get a chance,
okay, perfect.
maybe you can pass that on to me. So as Alina mentioned today, we are grateful to have Simon Rubinsohn. Simon Rubinsohn is a chief economist for the Royal Institution of Chartered Surveyors, and he's our guest today. Let's load up the PowerPoint presentation, and then we're going to proceed at that point. Let's see, Alina, if you have it there. Otherwise, I will pull mine and share my screen.
You can pull yours and
I'll
share
pull
your
mine.
screen.
Okay,
yes.
let me just pull mine. Just bear for a moment here, and I will get the presentation here. And let's see. All right. Simon, just bear with me for a second as we go through this technical matter here. But as we do that, perhaps a good way to start to sub is tell us about yourself and what, again, for listeners of ours, what is the Royal Institution of Chartered Surveyors? Give us a brief update about RICS and yourself.
Okay, well, RICS, our Royal Institution of Chartered Surveyors, is a professional body covering, I suppose, the widest sort of environment in terms of the built environment, focusing on sort of obviously land, property and construction. It's a professional body, so there's an accreditation to become a member of RICS, and that is in some cases necessary. Generally, it is not necessary to practice. There's certain sectors where it is necessary, and there is a regulatory function that supports parts of the profession, but other parts of it are not regulated. The role I perform is very much around gaining insights from our members. So we have about 130,000 members globally who work in primarily sort of commercial real estate and construction, but a whole host of other areas, including residential property in a number of countries. And I sort of, amongst doing other things, run a series of surveys designed to gather insights on a high frequency basis. And we get very good responses, and that provides me with a lot of understanding and ability to analyze market trends, feed information to a range of stakeholders, including the RICS, in terms of it developing its strategy.
Perfect. Thank you so much. Now, how many members does RICS have at this point?
It's around the 130,000 mark globally.
Oh, okay. And so let's, I'm having some issues with the PowerPoint, just getting it downloaded and shown on the screen. So what I will do is I will proceed a little bit and
Roberto, I have them up.
Okay, perfect. Thank you. All right, thank you. Let's proceed to the next screen. Thank you. All right, so tell us about RICS and how you gather the information and how is that used?
So as you can see here, look, there's two particular products I wanted to highlight here, which are our two sort of almost like our key sources of insight. One is on CRE, and that's the left. The one on the right is construction. And we get about 6,000 responses each quarter. And that's, I think, probably as good as anyone else gets in terms of high frequency surveys. The CRE survey goes back to 2008 on a quarterly basis. So that's also a pretty good run of data. Now, this is sentiment. And it's constructed in a net balance format, or most of the questions are. There are some quantitative forward-looking questions included as well, but it is essentially a net balance, which is, fairly standard, and I'll actually be showing some slides over the next few minutes, actually from the senior loan officers survey, that the Fed conducts, and that's conducted on a net balance basis as well. So very standard way of approaching gathering sentiment. And what we are able to show, we're not going to be using it in this particular period, we're able to show how our indicators are good as a lead to where markets are going. And in fact, the ECB, or some economists at the ECB, just 2 years ago did a 60-page report looking at our data, and concluded that it was helpful both as lead indicators and also to fill in where there are data gaps.
Now, Simon, what is the ECB for those who are not familiar?
Oh, sorry, the European Central Bank. So the equivalent of the Federal Reserve, covering Europe, excluding countries like the UK who are not part of the euro area.
Perfect. Let's proceed to the next screen. Presentation. Let's see. There we go. So give us an idea as to how this, what is RICS seeing, and how is this economic information being used by the members, and again, your role in this process?
Yeah. Well, look, I think the starting point, and I think as we move on, and we'll begin to think about sort of real estate and the wider valuation related issues. But I suppose understanding where, in this case, perhaps the US economy or the global economy is in the cycle is really helpful in providing some sort of parameters around which discussion on real estate valuation, construction can be framed. So I thought it was useful to actually look at sort of in particular, just because of perhaps the focus of today's conversation, just look at where we are in terms of the US. But, actually, the picture is the same globally, that if you were to look at news flow, a lot of the talk about recession at the back end of last year didn't materialize, and even now, I don't think there are any of the major economies who formally, technically, in that 2/4, of negative growth could be defined as being in recession. So we've got quite, we've had this big build up, which helped, to help frame some of the conversation about the downturn. But there's been a resilience in the global economy. I mean, it's been helped by the fact that some of the inflation aggregates have come back recently, helped by the fall in energy costs. But you can see here, this is the Fed's, or the the US business cycle indicator mapped against recessions. And, if you were to look at this, we're still, we're not in recession in the US. Although, I mean, I note a lot of commentators are suggesting that with interest rates still moving upwards, that the risk is perhaps more for the second half of the year, that you could see a short-lived downturn, perhaps seeing a contraction output about 1%. But that is, I think, the way when I'm thinking about what I'm seeing in terms of our member responses around valuation, I think trying to understand where the sort of the economic cycle is and the direction of travel, and also where we've just been, is pretty helpful.
Are your members expressing any concerns about some of the recent bank failures, such as SVB and Signature Bank, and the role of HSBC and the acquisitions? Is that something that at this point is in your horizon or is being talked about?
I think in terms of the information we're gathering, in fact, our Q1 survey is just out now. So it's interesting that, you're going to have to, and we're going to have to think about this very carefully, because when you're gathering data, the fieldwork period covers a period of disruption in the way that this period is covering. We almost need to draw a line in the sand and say which responses came in at which point in the fieldwork period, and what was the news at that time. So when I looked at the data at the sort of perhaps middle of last week, and we'd only just opened the survey, perhaps it was Thursday, we'd opened the survey for a couple of days, we had 10% of the normal sample, so low. And if you looked at that data, you probably came away, and I think there is a slide showing that further on, that you came away thinking that investors weren't unduly concerned. And that is partly because, the tightening in lending standards that, is clearly being discussed hadn't come through at that point, and probably hasn't come through yet, but we will see it emerge. And I think that if they aren't concerned about what's happening, they ought to be concerned, because while this is in my book, this isn't a Lehman Mark II, and I think that probably is the consensus. It isn't. We're not rerunning the global financial crisis, but nevertheless, what this is showing is the vulnerabilities in the financial system. As interest rates move significantly higher, and unless we believe that we've actually reached that peak point and rates are going to come down, and I think markets may be moving in that direction, but I'm not sure that central bankers are. And just to reference the European Central Bank again, they raised rates last week by 0.5 point. We've got the Fed decision this week, and I think people are sort of still on balance suggesting perhaps a 25 basis point move. I think that suggests to me that even if our members haven't factored it in yet, and I'm not sure, I think they're like all of us trying to understand what's going on, trying to assimilate the information. I suspect when we get our full results in, it will reflect a level of nervousness that I'm picking up from my interactions with other stakeholders, be it bankers or other policymakers.
Perfect. Let's go to the next slide. Here we go.
I think we can skip through this. I mean, I just wanted to demonstrate, and I think we're all aware that financial services are large contributors to GDP and, not just in the US, but globally. So, we've got to be very mindful about the potential impact on the macro of what's going on in the financial and the macro, and then indeed, whether it is business or real estate valuation will flow from that. So I think that, we really need to try and get as much of a handle and try and understand what's going on, but clearly there are huge uncertainties at the present time, and the news is breaking really. I mean, interestingly today, of course, and we know what started off as a weekday for bank shares seems to have been turned round, so one might take a little bit of comfort from that after the interventions with Credit Suisse, but that may be premature. So I don't think there's much to add on this slide beyond that.
All right, let's go to the next slide. Thank you.
Okay, so what I wanted to think about was valuation, and one, business valuation linked to the economy, and then real estate valuation. And I thought a good place to start was just to look at what's happened to lending standards in this cycle to start with, and that's before, of course, what we're seeing now. So I think this is quite interesting that the senior loan officers sort of indicator for a tightening in lending standards, that blue line, does seem to be pretty well correlated. I mean, the lags, or I'd say the lead, is not stable by any stretch of the imagination, and I think you can see that in terms of its relationship with unemployment. Nevertheless, it does seem to have some quite strong relationship, and while we know that that the labour market this time round is very different, not just in the US, but globally, everywhere. In the midst of the challenging environment, unemployment has remained and is generally predicted to remain relatively low. If I was looking at this chart, I would assume that blue line, the next lending standards survey by the Fed, that blue line will be higher. It probably will be up at the 80-odd mark that we saw at the height of the pandemic, or indeed not far short of where we were at the GFC. And I would have thought that orange line, unemployment, will turn up a little bit. And if you're thinking about, what that means that there is, perhaps a further slowdown in the economy in the second half of this year, which is, I think, justifies my concerns that we could still see some sort of recession. It just won't be a very deep one. But that has clearly implications for valuations. So I would be this slide tells me that there's the reasons why one should be cautious, really, even before the last week or two. But I think adding that on justifies a bit more caution still.
All right, let's go to the next slide.
And mindful of the time, I mean, I'm just looking at, if I was to look at this is looking more at the CRE. Now, the CRE survey that the senior loan officers run actually doesn't go back as far. So we can't go back and look at the the GFC issue. But again, there's a pretty good, this time it's an inverse relationship because I put it against the RCA CPPI index, year-on-year change. And you can see there that, I mean, again, you might question just how strong the relationship is. I think it's indicative. And if that blue line is heading higher, the standards are being tightened further. I think that it sort of implies to me that we haven't seen the pressure on real estate run its course. I suspect that this process is going to. It is just looking at this. It is meant to be inverse. Apologies. Yes, it is.
Mm-hmm. Okay, and let's go to the next slide.
So just following through on this, I mean, you might suggest that any sort of speculative type of industry is going to be more vulnerable in this sort of environment. I've taken and grabbed a chart that Oxford Economics, the consultancy, have produced, looking at banking crises and the impact on pricing in the commercial real estate world. I've also seen a lot of comments about how this might play out in housing. Similarly, clearly, if lending standards are tightened, it's going to have an impact on a very material impact on demand. But again, I think this highlights the risk around these sorts of more cyclical assets. And I think that's, again, something that one's got to be very mindful of when lending conditions tighten up. And we're not talking about a seizing up, we're not talking about that sort of GFC, but even if they're just tightening up, it's likely to have be challenging. A banking crisis clearly would be much more material.
All right, I think we have one more slide left here in the presentation.
I think we can jump this one. This is just telling me that actually what I've heard so far from our respondents, and it was early days, was that actually they were sensing the Q1 wasn't that bad in terms of perhaps the news flow, and perhaps until the banking crisis, it wasn't that bad. I mean, inflation coming down, it looked a bit better, and that's what this seems to be telling me. I'd be very interested to see what the next 90% of respondents tell us. But if we just look at the final slide, I just wanted to highlight, that actually, pretty much everywhere, what we've seen in terms of one-year bond yields is obviously a rally. I mean, to be fair, we're seeing widening spreads. If you look at the spreads against corporates, they've moved out about 45, 50 bips over this same period, over the period of the banking challenge. But what you have had is this strong rally in one-year bond yields. So I mean, and I would interpret that pretty clearly that short term we're likely to see further rate hikes. I mean, I think the Fed will probably go a second time in May. ECB, Christine Lagarde, said that she wanted to do more as well. I don't think anybody wants to give up the fight against inflation. There is a concern about core inflation becoming embedded. But I think what this also tells me is 2024, there's a risk that policymakers are going to overdo the tightening, and markets are sort of sensing that 2024, we could actually be looking to rate cuts, and perhaps rate cuts coming through sooner than would otherwise have been the case.
Very good. Well, Simon, I think that that comes to the conclusion now of our time. Any other comments or things that you'd like to share with the audience about what's going on in RICS? Or
No, well, just like I noticed there's a point being made about inflation, and I wouldn't disagree with that. I think that, but central bankers, particularly in the current inflation environment, are inevitably finding it challenging to address inflation. Inflation is being driven by extraneous factors, but I suppose that they have mandates, and whether they soften those mandates or those mandates are softened for them may be something that will emerge over the course of the next year. But I think for the time being, given the mandates they have, they are clearly going to remain focused on inflation. And in terms of what I mean by core inflation, I suppose what we've had is this sort of really energy-driven inflation in most countries around the globe, raw material inflation. And the question is whether or not that gets more, and when I say embedded, I mean, it feeds into sort of wage increases, pay increases, hourly pay increases, depending on which index you're looking at, which country has measured, that are perhaps more reflective of an inflation environment around, let's say, the 5, 6, 7%. If I looked at what I'm seeing in the US, if I look at what I'm seeing in the US, in Europe, the pay settlements are in that sort of area. That still means, real incomes being compressed, But nevertheless, what it could do is fuel another round of price increases to match those wage increases, as you know, to protect margins. And in that sort of environment, you know, that's when I talk about core inflation becoming embedded in the system.
Wonderful. Well,
Thank you, Roberto and Simon.
Thank you, Simon, and have a good evening in the UK. Thank you for joining us.
Thank you.
This was great. So with that, we're going to move to our next segment. And I'm going to introduce Michael Kaplan, who has been got kind of a pillar of NACVA and one of the top instructors, a lot having to do with litigation, testimony, expert witness, developed numerous courses. And he's going to be having a special segment with our honorable judges, taking your questions and answering questions around that. I'm going to let you, Michael, take it away and introduce the judges, and welcome aboard.
Thank you, Mel. And I thank you so much for your kind words. I'll give you the check after the program. This is going to be a great session. We have with us today, I believe we have all of our judges here. We have Judge Platt, Judge Stephen Platt from the state of Maryland. He is located in Annapolis, Maryland, retired judge, although he is very, very active professionally in the alternative dispute resolution arena. And he is the head of the Platt Group. I met Judge Platt many, many years ago, the first time that representatives from NACFA went up to the National Judicial College to explore the possibility of doing some programs with them. And great to have you here today, Judge Platt. We also have with us Judge Christopher Yates from the state of Michigan. Judge Yates was a trial court judge for many, many years. And I believe it was about a year ago that he was appointed to the appellate court. So he's got a little different perspective. And I had the opportunity to meet Judge Yates about 10 years ago, the first time we did our actual program with the National Judicial College. And just a great instructor, great judge, great source of perspectives in our world in the courtroom. We also have Judge Timothy Driscoll. Judge Driscoll, are you here with us today?
Yes, sir.
Yeah, I see you there. I see you there. I was just looking for your picture up on the board. Judge Driscoll is a trial court judge in Nassau County, New York. Also a business court judge, and we have been doing NACFA programs together. I guess it's probably going on 3 years since you've been involved in the process of the NACFA conferences and various other educational programs. And Judge Driscoll always has outstanding perspectives. I want to add that our three judges are also very involved in the American College of Business Court Judges. Judge Platt was one of the founders. Judge Driscoll is, I believe, the immediate past president of the American College, and Judge Yates is the president-elect. And we have the opportunity of working with the American College of Business Court Judges in presenting various programs. So here we are today, and we have an open question session. This is an open forum, so please put your questions into the chat box, and then I will pose your questions to the judges. Now, since I'm moderating the session, I get to go first in terms of questions, and I'm going to direct this question to Judge Platt because Judge Platt has the longest history in the judiciary. He's been at the trial court level, now is involved in ADR. And I know that there is one question that Judge Platt asks in every case when he meets with counsel, and that is, why hasn't this case settled yet? And that's been a topic that we've presented at our conferences and continue to present. So here we are as experts, and some of us have got a lot of experience, many trials. Some of us are relatively new to the world of being experts. But what is it? What is it that we as financial professionals, as financial experts, should be doing in our cases, starting from day one and at all points along the way, throughout the process of our doing our work and supporting the efforts of counsel in a case? What should we be doing proactively as part of our engagements in legal disputes to enable counsel, to help counsel, to facilitate settlements prior to trial?
The first thing that you should do is make sure that counsel who has retained you and wishes to, along with his or her client, settle the case. That is not a presumption, that's a question. Because there are attorneys who and or parties who do not see that as a primary goal. That will govern to a certain extent what it is you do and what your role will be, at least in the initial stages of your being retained. Because if their goal is to settle the case, or if they can, then that shifts you into a different gear than it would if they said, we are going in this for the long run. We have a reason we want to be heard and seen in a courtroom, and we are not particularly interested in settling the case. That changes what you're doing and perhaps and likely when you do it. Let's assume that the question you asked presumes that the parties and that the retaining counsel and his or her client wants to settle the case. That means you prepare and evaluate the case, and I'm sure we're going to get to the issues on how to do that and what you need to do that. But you collect the data you need, the information you need from whomever you need to get it from, presumably through counsel, to do that, and then you evaluate it. Your opinion at that point, if you're really trying to settle the case, is not a secret, or should not be, once it's established that it is what is, and that you're on the same wavelength as the party and the attorney that hired you. Also not something to be presumed. Once you've done that, and then the question is, the communication begins, and the way to settle cases is to communicate. And so again, find out what it is, the expectation is, what the goal of the party and the retaining counsel and the client is, the timing of reaching that goal, and what your role as they see it will be, and whether you as an expert are comfortable in that role and with the staging and the planning and the implementation of all of that with a goal of settling the case.
Now, what if you can provide a perspective on the case that the attorney doesn't recognize, the attorney is not aware of or hasn't thought of it? For example, one of the things that I often get from my retaining counsel is, as I'm preparing for trial, as I'm getting everything in order, the valuation, the damages study, all of these things that I need to do, the attorney will say, we are having a mediation on the 17th of April. I don't want you to do any more work. And then after the mediation, if we don't settle it there, then we want you to gear up.
My answer to that, if you're still asking me, is that means their primary goal is not to settle the case at this time. The preparation to litigate and the preparation to mediate are two very different processes. Some overlap, but they're different. The timing is different. What you do is different. And you should also have a conversation where, again, if he's trying to settle the case, not having your opinion available to the mediator and to the opposing party so they know what they're up against is not conducive to that goal or to settling the case. And many attorneys and many clients aren't sure what they're trying to do. They're mediating under the theory that somehow or other a mediator is going to walk in and know what they're trying to do when they don't. And as a result, that's a prescription for a failed mediation, at least in the first instance. So the answer is, again, that role is different and it needs to be clear. And frankly, your fee also needs to be clear, because if you're trying to settle a case, then what it is you're going to have to do to prepare for litigation becomes relevant and is not and should not be a secret at the point where it becomes a factor in the settlement of the case. Risk analysis should be included in the opinion that you offer, and your involvement should be justified and explained and hopefully received. Most cases that have an expert opinion that is going to be an important opinion in the case, whether it's litigated or settled, does not settle on the basis of I'm not telling you what my expert and I'm not having him or her express an opinion until it's clear we can't settle it. That's the exact opposite of what should be done to try to settle the case.
But the point that Judge Platt makes are so perfect, and it ties into, I think, the second part of the equation, which is from the perspective of all of you, to make sure you tell the retaining attorney, look, I can help you at trial. But, and if you're looking to potentially settle this case, I can help you there also. Look, as an expert, you are not an advocate. And we keep saying that. And I feel sometimes like I'm John the Baptist crying out in the wilderness, saying that at every time we all get together. But it is very much worth saying every time. You are not an advocate. So impress that upon your retaining attorney. Look, I'll come to conclusions. Those conclusions, believe me, I will test them out. I will work with you to make sure those conclusions are appropriate from the witness stand. But I can also help you in advance of making those conclusions on the witness stand. I can help you as part of the settlement process. But it really ties into Judge Platt's question, which is to really to know what your role is. Know what your role is, but don't be afraid, and don't be afraid to let the lawyer know you can take on that other role of assisting them in the settlement process.
We have got a question from one of our attendees. Why do judges tolerate attorneys who are known to abuse the due process concept by refusing to cooperate with discovery?
If you don't mind, I'll start with that one. I devoted a couple of years of my life to discovery reform in Michigan. We rewrote all the court rules. The aim was to streamline it, simplify it, make punishing gamesmanship much easier for trial judges, and to accommodate all of the concerns raised by discovery of electronically stored information. I'm pleased to say that we moved the ball forward in some significant ways, not the least of which by giving trial judges tremendous discretion in imposing sanctions. I was the judge when I was on the trial bench who was always committed to trying to fashion a remedy designed to the violation. The biggest problem with discovery is that it's asymmetrical. With very little effort, one side can put a great burden on the other side to produce information. And then besides that, unless the judges are willing to really dig in and do the hard work, discovery problems will just fester. I think all three of us in our role as trial court judges were committed to getting involved deeply in discovery disputes early on. I always used to take the bad behavior cases and call them in, where we would spend half a day just talking in chambers. And anytime we couldn't work something out, we'd go into court, we'd hash it out on the record, and I'd render a ruling. And it became obvious to everybody who practiced in my business court that discovery abuses not only were not to be tolerated, but were to be punished in equal measure to the extent of the violation. And I hope that business courts have brought more focus on discovery abuses, because you're absolutely right. If a judge isn't willing to wade in and get dirty dealing with discovery problems, they just get worse.
I have a follow-on question to that. In fact, this one also came from David Goodman, who was the person who posed the last question. When there are discovery issues and the expert who's not getting what she needs to do his or her work to complete their engagement, often the expert will prepare an affidavit, a declaration, in support of a motion, to produce the documents and produce the evidence. Why is it that sometimes the judges just don't trust what the experts say they need to complete the engagement? They ask for it.
It could be that the declaration is not as clear, or it could be, again, who is the one actually giving that information to the judge? The judge is reading the declaration, but the judge is also relying on the advocate who is before her to shape the presentation. So I think it really makes us as judges reemphasize the point that we often make, which is that the relationship between the expert and the retaining attorney really has to be one of mutual comfort and mutual respect, such that it's not all the attorney asking the expert, well, tell me what I need, and give me what I need. It's got to be an iterative conversation, and the expert can't be afraid to say, look, retaining attorney, this is really what I think that the focus is that I need to move this case forward. So the expert really has to be comfortable with the retaining attorney, such that the retaining attorney can make that presentation to the court.
Yeah, I would add to that three of us have really been preaching for years this idea that the expert witnesses, particularly when they're in an area that the attorney doesn't understand very well, have to be much more than just a piece of a puzzle to be plugged in. Our view, all of us, is that we always prefer to have experts participating in settlement conferences, for example, because experts can add a layer of sophistication that we just can't get from most of the retaining attorneys. And so I don't know how you manage your relationships with a retaining counsel, but for what it's worth, you have advocates in all of us for the notion that you should be, if not equal partners, certainly very significant partners in the process.
The only thing I would add to that is that, again, everything that Judge Driscoll and Judge Yates said is extremely important, and we've been saying it in almost every program we've been in. That said, not to put the blame on anybody in particular, but retaining counsel needs to understand what it is they're doing, and the expert needs to understand where we are in the litigation process. And the question, as it is in anything, the framing of the question or the framing of the issue for the expert is extremely important. And the partial answer to the question of why didn't the expert's opinion get accepted is maybe the question wasn't right. And maybe the opinion is not relevant to what it is that's being decided. Maryland is now in the process, the case is in the appellate courts, and I'm not sure whether it's gone to what's now named the Supreme Court. Used to be our highest court, was named the Court of Appeals. But bottom line is, in addition to Daubert now being adopted, now there's a case that says we can exclude, or that is proposing to have the appellate court say that you can and should exclude an expert's opinion if the data that they are basing that opinion on is incomplete or inadequate. That's going to change every relationship If the answer is yes, you can and should do that, trial court judge, that's another component of your gatekeeping function. Now we not only are we making the judgment about methodology that we used to defer to the quote relevant scientific community, now we're going to become quality control officers, and we're going to have to decide whether the data that the expert used, which means if you're the expert and you don't want your opinion excluded and your professional reputation affected, you got to watch what they're being given and the information and the evidence that you're basing your opinion on much more than you used to.
And Judge Platt's point ties us into the preview to the movie that will begin to be played later this year, absent any contrary ruling by the Supreme Court, and that is that Federal Rule 702 has been amended to be effective in December of 2023 to really put on the trial court the gatekeeping function and make that a much more rigorous gatekeeping function. So I do want to emphasize that the trial judges who follow Rule 702, which are again will be all of the federal judges, and then many states will go along with that either by operation of law or over time, will be very much taking their gatekeeping function even more seriously because the rules are now requiring that. In the old days, meaning now, the emphasis was, well, I'll let it in and the jury can figure it out. And truth be told, that philosophy that makes a lot of sense in many ways. I'll defer to Judge Yates on whether he agrees with that philosophy or whether he has dissension from that philosophy now, but it guarantees that you won't be trying the case twice, or it renders less likely to be trying the case twice the more that you let in. That being said, the drafters of Rule 702 have now said, no. The judge really has a gatekeeping function about those four prongs of Rule 702, and the judge has to make sure by a preponderance of the evidence that those prongs are satisfied. Now, that being said, that's not all that remarkable because that was the law before that. But by reshifting where the rules are, much like a couple of years ago, the rules reshifted proportionality. The thought is that the trial judges will now understand the emphasis on their gatekeeping function. So long and short is you don't want to be the recipient of an order precluding your well thought out testimony and your well thought out report, as Judge Platt said, because of course it's your reputation, which then goes forward from that. So just to be aware that judges very much will be taking that gatekeeping function even more seriously with the advent of the new rule at the end of this year.
And you need to, and I would simply emphasize what Judge Driscoll just said, you, the expert, need to let counsel know this is not a time. There are lawyers who don't give you information or give you incorrect information or inadequate information because they see their role as an advocate and we're not going to give our expert information that's going to cause him or her to have an opinion or to even modify their opinion even slightly that it's not as favorable as it would have been if I hadn't told them that.
Somebody asked a question in the chat about the case we're discussing. There were actually two legal authorities we were discussing. The first is a case called Daubert, D-A-U-B-E-R-T versus Merrill Dow Pharmaceutical. It's now getting to be an older case from the United States Supreme Court on expert testimony. And as Judge Driscoll said, it prescribed a gatekeeping function. But what Judge Driscoll is describing that's more significant today is a proposed amendment to Federal Rule of Evidence 702, which would really hammer home the idea of trial courts keeping expert testimony away from juries unless the expert testimony is reliable.
I believe that's going to make a big difference in many of the cases. And, if there is a challenge and if the judge holds a hearing, the expert in effect is going to have to give his or her testimony, their complete testimony to the judge prior to his deciding his ruling on whether that can go before the jury. Am I correct, or
Absolutely correct. Again, it's meant to
Absolutely.
shift the focus to make sure the judge understands her or his gatekeeping role. Again, not all that remarkable, but the reordering is designed to emphasize to the judge that gatekeeping role.
And somebody just asked a question about the impact that this will have when an expert can't get enough discovery to formulate what they believe to be reliable opinions. What I would suggest is that this really necessitates getting your discovery that you need in your hands sooner rather than later, because it used to be, if you were ready to go at trial, you'd be fine. Now you have to be prepared for a Dauber challenge. And I think all of us have always insisted that Dauber challenges come well before the trial occurs.
Yes.
Another question. We've heard Judge Yates explain what he has done in the case of an attorney who has played games with discovery and hasn't produced the evidence, produced the documents that that were sought during discovery. What about an expert? You have an expert who takes the witness stand, and the expert is supposed to be an expert, and in my mind, his or her opinion should be the same no matter which side, no matter which party's attorney retained that expert. As I describe it, my client in this case is the truth. I just want to I'm here just to get at the truth and testify as to what my opinion is. When you have an expert take the stand and it's clear that the expert has become an advocate and is functioning not as an independent, unbiased, purely objective expert, what do you do? What are some of the things? How do you handle an expert like that? Do you punish him or punish her, or are there other approaches?
I think the first question we asked is the trial a bench trial or a jury trial? In a jury trial, obviously, the judge will not be speaking as much unless the lawyers are making objections. And so it's harder to read the jurors. You don't know if a yawn means they're tired, they're bored, they're disinterested, or they're just catching their breath. So I think it becomes much more difficult in a jury trial to get those cues. That being said, having conducted a bunch of jury trials in my 15 years on the bench and many as a prosecutor, juries get it. Juries get it. So they don't like people stepping outside of their role. Judges will, of course, ask a lot of questions. I would beware of the judge who doesn't ask any questions, because that means the judge really isn't as interested, or may have made up their mind, at least preliminarily. So you may think you're how wonderful of a teacher you are and how authoritative you are, and the judge can't even question you. Well, that's not all that great. So I would say that would be a cue that maybe you should change your presentation. And it could be, although you didn't ask this, Mike, it could be your presentation is too esoteric. It could be your presentation is boring. It could also be, though, that you're taking on too much of the advocate hat. So I would say the quieter the judge is, the more you should question, gee, am I really getting my point across here?
I think if I could add to just emphasize what Judge Driscoll just said, I have on more than one occasion said to an expert and or counsel, depending on which one is the most effective vehicle. I've actually done it in front of a jury as well, although it's easier if there's no jury, and said, here's my problem with your opinion. And I'm telling you that, and I'm doing you a favor, because particularly if I'm the decider or the decision maker, and even if the jury is, I've got to decide how to instruct them. And or if if it's a court trial, then, or as an arbitrator, I'm deciding. And here's my problem. And I assume, counsel or Mr. Expert, that you would rather have me tell you what the problem is now so you can address it while it still can be addressed, rather than tell you what the problem was in my decision or my written opinion. So I'm doing you a favor. In addition to that, if it's a liability issue, which is likely it is at some point, at some stage, usually this is on a dispositive motion argument of some sort. So here's my problem. And if they are an advocate, they're going to have a trouble because they weren't prepared to answer that question. And if that's the case, that should be evident to whoever, whether it be a jury or a judge who's listening to the case. So the answer to what do you do is not punish them, except to the extent that they're having to ask your questions that they're uncomfortable receiving. You're, in a way, you're punishing them, but it's punishment in the tradition of the highest tradition of our judiciary. Talking judges.
If I can just add one more point to this, when I was trying cases, I would always tell each witness, you don't have to win the case by yourself. What you can do that's most effective is listen to the questions that are asked and answer them to the best of your ability. And I would say that to all of you who are going to be testifying as experts, and I'd say that to anybody who's going to appear in court and testify. It's all too common for people to show up and try to win the case on their own, and you don't have to do that.
Great. I want to thank our judges for being with us today. Just very, very excellent insights that will be of assistance to all of us. And thank you very much.
Thank you, everyone.
Thank you to the judges and Mr. Kaplan. Now, before going to our next session, we're going to have a segment switch. Make sure you can respond to your polling question that is right now. Go ahead, Chanda. Okay, we are back. So we apologize for the audio, but we are dealing with that. But for now, we are going with Mr. Michael Mulder. He's going to be talking about the case law summaries this month. So, hi, Michael. You can take it from here.
Hey, how are you all doing? Really tough act to follow with the judges, but I will give it a shot. That's me. You've seen me before. No big deal. Case I'm talking about this week is called, and I'm going to butcher this, Mikaya versus Eastland Food Corp. Comes out of Maryland Appellate Court, dating back to December. And it's a really interesting case. If you want a copy of the opinion, you can either email me for it, or it'll be available in the eValue data case law database. So the things that we're looking at in this particular case have to do with dividends and distributions, excuse me, and issue of excess compensation and what we like to call the prerogatives of control, something that is near and dear to practically every valuation professional. So the story of this case, this company is a food distribution company, originally founded by the plaintiff's father. Plaintiff joined the company in 2000 as the vice president of operations, and he was just an employee until 2008 when he became a 28% equity holder. He is a director, was a director of the company, along with his brother and his mother, and then there was a fourth director who was just a third party, no family relationship. So the ownership of the business, and again, all I can tell you about is what's in the opinion. I don't know how some of these things ended up being the way they are, but they raise a lot of questions on their own. So the ownership interest is split between the plaintiff and his brother, who each have 28%. Their mother holds 35%, and then the plaintiff's nieces and nephews, the brother's children, have 9% of the company. Again, I don't know whether they are minor children. I don't know whether they are adult children. There's just this is one of the problems with judicial opinions, is it leaves so many questions. So in 2017, a vote was taken to put dad out to pasture. And the plaintiff was opposed to this idea. But mom and Oscar, the brother, and Oscar's children exercised control over the company. They had majority interest in the company. And so they decided to put Oscar in charge. And again, I don't know why. I don't know what was going on in the family. But this is what happened. And then a year later, the plaintiff gets terminated from the board and fired. So he's removed from the board and fired from the company. At the time, he was making $400,000 a year. At the October 2018 board meeting, just before the plaintiff was terminated, they raised an idea they discussed the idea of shifting the payments of dividends to actual shareholder distributions rather than having things lumped in as salary to bring down corporate profits to nothing. After plaintiff was removed, that idea went nowhere. So the case is brought by the plaintiff, who is alleging a number of things. The first, his primary complaint is that he suffered from oppression because the company was paying out dividends. The profits of the company were being distributed to the officers of the company as salary rather than distributions as dividends. And he also complained that after he was terminated, his brother and mother were getting paid excess salaries to continue to eliminate the profits of the company, and prevent distributions from being made. So we set forth 3 counts. The first one was shareholder oppression, and then the other 2 were related to the director's breach of their fiduciary duties and mom and his brother being unjustly enriched by their excess salaries. Trial court dismissed the case with prejudice, concluding that dividend as salary is not a recognized theory of oppression. And I will tell you that, having discussed this issue with a couple of corporate shareholder dispute lawyers, this is going to be a growing issue. So, and then with regards to count 2 and 3, the breach of fiduciary duty claim and the unjust enrichment claim, the court determined that those are claims that properly belong to the company itself, not to plaintiff, who is just a shareholder at this point. And because the plaintiff didn't say that the complaint was being brought derivatively, and didn't satisfy the requirements for pursuing a derivative claim, he didn't have standing to pursue those claims. So the appellate court gets the case. It's important to remember that at this stage of the game, this case has only been, there's only a complaint that's on file. And for purposes of the motion to dismiss, all of the facts alleged in the complaint and any inference that might be drawn from those facts have to be viewed in the light most favorable to the plaintiff. And if, after construing all of this in favor of the plaintiff, you still make the court still makes the determination that there is no legal basis for the claim, that's when you can dismiss the case. So we're not talking about any evidence right now. There may not be any evidence to support the plaintiff's claim. That comes later in the process. And the court's finding was that the concept of shareholder oppression comes back to adverse treatment of a minority shareholder. And it has to be based, it has to attach to a reasonable expectation of the shareholder, of that minority shareholder. So the key issue is whether the expectation, the shareholder's expectations that are being complained of were reasonable versus personal or subjective. So if this was all about the plaintiff saying, I want mine and my brother's getting more than me, that's not good enough. It has to be a reasonable expectation of returns. So, here we go. Court also found that a plaintiff's expectation of a pro rata share in the profits of the business is a reasonable expectation. And therefore, his allegation that the profits of the business are being distributed through employment, through compensation of employees, is a violation of the reasonable expectation that he's going to participate in the profits of the business. And so it reversed the trial court's finding, concluding that, and I'm pushing because I don't want to run over, but concluding that that he had stated the claim. There we go. So the things that are important, and we do this all the time as part of the process of doing evaluation, we normalize excess compensation. We go through and attempt to figure out if the company is paying its shareholder owners higher than market rates in order to determine what a arm's length compensation could be. One of the things that we don't typically consider, and I think that we should be at this point, is whether or not that excess compensation is a disguised distribution, and whether or not those distributions are being made in accordance with share ownership on a pro rata basis. Because if you're paying out $1 million in compensation that is actually dividend, and it is not going to the shareholders on a pro rata basis, you have a potential problem with undue or improper distributions. Now I will unshare and we can move on.
Thank you, Michael.
I tried to do it quickly.
You did. I appreciate it, man. I know we gave you a short period of time, but great case, and I'm sure there's more to it. So I appreciate it. So we're going to move on. I'm going to introduce you really quickly so we can get jumping in. Brien Jones.
Hey.
How are you, my friend? So good to have you here.
I'm good, and I'm so glad to see everyone, and also Will. Since we're crushing time here, we'll just jump right into this next segment. Will Casserly is the account director with Hinge. He has spent 25 years building expertise in a wide range of disciplines, including marketing, communications, media, public relations, graphic design, video production, and business development. In this segment, he will share with us accelerating growth, insights from fastest growing accounting and financial service firms. Take it away, Will.
Excellent. Thank you, Brien, very much. Appreciate it. Is the slideshow appearing on the screen? Can we see the first slide?
Yes.
Excellent. Thanks. So first, thanks very much. Appreciate the time together, and we'll see if we can't work through this quickly and get everybody out to lunch or early start out in the day. So as I mentioned, Hinge is a branding and marketing firm. So we've had a long-standing relationship, a partnership with NACFA, very much appreciative. And one of the things we're going to be sharing today is some research. So through our research arm, the Hinge Research Institute, we do a good deal of qualitative and quantitative branding research on behalf of our clients, and a lot of research on industry trends and what's happening inside of different industries. So today we wanted to take a look at what we call the high growth study. This is in its 8th edition now. And our first studies date back about 15 years ago, back to 2008. And we were able to see some noticeable shifts in what was going on in the marketplace, and quickly became an annual report that we produced. So since that time, we've studied over 40,000 different organizations, and the report has really become standard for understanding what really drives high impact marketing programs. This year, we looked at over 700 firms representing about 6 industry groups, and a little over 170 billion in revenue and more than 600,000 employees. So the research itself, we've broken down into 6 different segments. Today, we're going to be looking at the accounting and financial services segment of that. It was one of our largest groups, respondents of a little over 13%, and prime decision makers inside of this group. So senior executive, partners, and also managing director levels. So marketing directors or other marketing and business development roles. Inside of the financial services space was roughly about 150 firms inside of this. And so one of the things that was one of our main takeaways from this is looking at 2 of these items, one being annual growth rate, and the other being what percentage of marketing revenue was dedicated to the firm. Interestingly enough, the takeaway from this, we've seen a little bit of a dip or a little bit of moderation in growth from 2022 to 2023. And often when we see this, we see marketing budgets pull back as well. But we haven't seen that this year. They're actually overall on an increase, up from 11% overall to 12% this year. And we think there's a lot going on in here, but we think that's is primarily due to firms transitioning in the way that they're marketing into becoming more digital, more online strategies from this. So what we do with this is we pull this out and look at what the high growth firms do. What do we term or define as a high growth firm? Ones that have a 20% compound annual growth rate over a 3-year period. And then we compare those to their counterparts, ones that experience little or no growth over the same time period, and really measure kind of what strategies and practices are associated with it. So why are they growing faster and being more productive? Here we see that that group, that segment, those high growth firms are actually growing 3 times faster. If we look at the chart on the left, what does that mean? That median growth rate, they're growing roughly 30% faster than their counterparts on that. And the takeaway from this is that not only are they growing faster, but that profitability that they're showing, that chart on the right here, is also greater at the same time. It's not to the one is does not have to be to the exclusion to the other. Just because you're growing fast doesn't mean that you're going to be less profitable. So from this, we've taken away really four main points that boil down off the research. What is driving the success of these firms? So understandably, the last few years have been a bit of a roller coaster, but it's not just COVID fatigue. It's not just economic instability, stock market volatility, political wranglings, the war in Europe. We know that industry-wide, the financial industry does not tolerate uncertainty very well, and that's really boiled up to the top of a lot of these things as well. That uncertainty is causing firms to lock up a little bit. But successful firms aren't doing that. They're moving forward. So how are they moving forward? Research has identified four main items: technology, talent, marketing and business development, and their overall strategy. So we're going to take a quick peek at all these. So this first key advantage is inside of the technology itself. Use of different technologies. And this spans a wide gamut. We all know, firms use a lot of different tools inside of that. So whether it's looking at some of the larger gaps in here, from the CRM tools, the project management systems, the knowledge management systems, we find that the high growth firms are ahead in almost every case when we itemize these things down, with the exception of one, which is human resources, where they got edged out a little bit by the no growth firms. So that's a good question. Why? One of the questions we asked was, what would you identify as your main business challenges in the next 3 to 5 years? And not surprisingly, the top item inside of this is the shortage of top talent. It's been a top issue for a number of years, and it continues to be. One of the things to notice out of here that of these top concerns that firms identify, 5 out of 7 of them relate to personnel issues. So finding people, training people, how do you manage staff, as well as increases in compensation. A lot of these things boil down to what we put in the bucket of the employer brand, right? What is our reputation as an employer, and how can we solve those problems? That really segues into the key advantage number 2 is talent. How do you find talent? How do you attract talent? How do you retain talent? And when we asked people to really quantify that, how would you score your company culture, rating it from a 0 to 10? In these charts, the top line is the high growth, the lower line is the no growth. And when we asked them to score that, the people who responded in a positive way, highly positive, that green line, a lot of those could be identified as senior personnel, people who were a little bit further along in the careers. Let's put the green side on the green responses on the side for a moment. Let's look at the bottom line, the no growth over on the left-hand side. 48.1% of people are unhappy. They're not unhappy to a way that's in the yellow zone, which is kind of more persuadable, where they might turn green or might turn red. These people are very unhappy with their firms. And so we asked them secondarily to that, like, if you are unhappy, what are the things that are most important to you? If we could make improvements to company culture, what could those do? What would those look like? The top responses out of that were, we'd like to see doing things to reinforce the company core values, or we'd like more transparency, more communication, more weekly status meetings was an important response, as well as in-person work-related social events. So a lot of people have been working remotely for a long time, and they're starting to feel the fatigue of that. A lot of people tie their personal lives, the social lives into where they work, and those opportunities to build relationships. And that's been missing over the past couple of years. So feeling that pain. The third advantage, marketing and business development. high performance firms, they're investing more in marketing. They have a better understanding of SEO, of search engine optimization, and how to implement it correctly. And they're also generating a substantial amount of more leads from digital sources. So 32.6% versus 18.1%. So although traditional marketing is effective with a certain proportion of your prospects or segments, there's still a very large growing segment that digital marketing is going to be more suited for moving forward. And that trend's really continuing. We've seen that. The fourth advantage strategy. In looking at this, we asked what are topics and trends people would like to learn more about into 2023. Workflow and process automation tops this. Value pricing, also deepening the online engagement with clients and prospects, and alternative billing models. These all are things that suggest high-performance firms are really looking for new strategies to draw in new clients from here. So overall, they're looking for ways to keep clients, create greater efficiencies, and really reduce risks inside of that. So one of the things, some of the benefits of NACFA, we wanted to remind you that Hinge University Professional is also available through the Practice Support HQ. There's a coupon code in there for NACFA 10. And additional resources, if you're interested about this, we encourage you to read the blog, Navigating Uncertainties, the 4 key strategies for financial firms to thrive into 2023 and beyond. And longer form, the webinar is also available on our site as well. And all of the reports are available as well. If you use the coupon code GROWD50, you'll get 50% off any one of the individual breakouts for the individual reports from that. Please, I realize we've had a short amount of time together. If you have any marketing, branding questions, just like to exchange ideas, we're always available. Please reach out on Facebook or LinkedIn or through the website. Appreciate the time.
And thank you also, Will, for those of you who want to quickly find how to get to these resources. If you go to the NACVA homepage, under the Alliances and Partners, you'll see the Hinge logo, and you can click that to learn more about some of the resources and studies that are published by Hinge and available to you as a member. What a great show this has been. Alina, Mel, everyone, thank you so much for joining us. We look forward to seeing you next month on April 17th. If you're interested in being a guest on the show, please let us know by sending an email to Chinda Chuan, who's a producer of our show. And if you have a topic that you're interested in seeing or a guest, something we can bring to you and the membership, let us know. We'd be happy to program that. And we hope you continue finding value out of Around the Value